Hello, everyone, and welcome to our Chapter 5 lecture. We have a very exciting topic today: how to form a business. So, you ready? Let's go. In this chapter, we'll look at some of the most common forms of business ownership, business structures such as sole proprietorships, partnerships, corporations, and we'll expand upon those. We'll talk about corporate expansions, mergers, acquisitions, franchises, as well as cooperatives. So here we have the three major forms of business structures: sole proprietorship, partnership, or corporation. The word sole means one, proprietorship means ownership. So with a sole proprietorship, you're going to have one owner. With a partnership, this is a legal form of business where now you have two or more owners with the partnership form of business structure. Now, from a legal perspective, when you have a sole proprietorship or a partnership, the owners are not separate from the actual business. So, to protect yourself, you can form what's known as a corporation. A corporation is a legal entity in which the owners are totally separate from the business organization. So we're going to talk in lots of details about three different forms of business structure. What this next slide shows us is the percent of businesses and their structure. So you can see overwhelmingly 72% of all businesses are a sole proprietorship, 8% are corporations, and 20% are in the form, 8% are partnerships, and 20% are in the form of corporation. But when it comes to total receipts, or what we call revenue, all revenue earned, 81% of our revenue is earned by corporations, 13% is earned by partnerships, and only 6% of total revenue is earned by sole proprietorships. So, yes, we have more sole proprietorships, but the bulk of the revenue earned comes from the larger corporation. Here are the advantages of starting a sole proprietorship. It's pretty easy to start and end a sole proprietorship. You are your own boss, so you have the pride of ownership. You can leave the company for your legacy, for your children, for your grandchildren. You get to keep all the profits, and there are not any special taxes when you have a sole proprietorship as your form of business structure. So here we have Evan, better known as Evan Tube HD. He started making toy unboxing videos on YouTube when he was a little kid. Now Evan has more than 6 million subscribers and he earns more than $1 million per year from ads and sponsorship. Pretty neat. So the question is, do you have a passion you would like to pursue as a business? And if so, what would that be? Now, there are some disadvantages of sole proprietorship as well. First, you have unlimited liability. All of the debts of the business belong to you because you are the sole owner. You may have limited financial resources, management difficulties, overwhelming time commitment. We'll look at a graph that shows the amount of time on average you would spend as being a sole proprietor running your own business. Few fringe benefits. There could be limited growth for your company and limited lifespan. So remember that with a sole proprietorship, you only have one owner. So if that owner becomes deceased, that business may fail to exist. So we mentioned what are the disadvantages of the number of hours, having a good work-life balance. That's very important. This graph is showing the percent of small business owners who work more than 60 hours a week. You see that on average, more than 20% of small business owners work more than 60 hours in a given week. at least 51% of those small business owners work more than 40 hours a week. So, yes, it's a great thing to run your own business, but there's a huge time commitment to running your own business. Next, we have partnerships that we call a general partnership and a limited partnership. With a general partnership, excuse me, is a partnership in which all owners share in operating the business and in similar liabilities for the business data. So pretty much each owner represents in the business has equal ownership of the business. Whereas with a limited partnership, you have a partnership with one or more general partners and one or more limited partners. So now the limited partnership, again, some of the owners will be general partners. So they're making all the decisions for the business, assuming the debt. With the limited partners, you have limited responsibility as being a limited partner within a limited partnership. So more information with the general partner, an owner who's a partner has unlimited liability and is active managing the firm. So the debts of the business belong to the general partners. As a limited partner, sometimes called a silent partner, an owner who invests money in the business but does not have any management responsibility or liabilities for losses beyond the investment. So you put money into the actual company, but you're not responsible for the daily operations when you are a limited partner. So, as a limited partner, you have what's known as limited liability, which means the responsibility of a business owners for losses only up to the amount that you invest. So, if you invest 10,000 into a business as a limited partner, your amount of risk is only the amount you invested. So, yes, you could lose your 10,000, but you're not liable for any debts beyond that amount. Other forms of partnerships consist of what's called a master limited partnership, which is an MLP. This is a partnership that looks like a corporation, and that with an MLP, you're able to trade stocks on an open stock exchange market. The beauty is that because it is a partnership, it's taxed like a partnership and it avoids the corporate income taxes. We have a separate chapter. We'll talk more about taxes for these different types of business structures. With a LLP, a limited liability partnership, it's a partnership that limits the partner's risk of losing their personal assets to only their own acts and omissions and to the acts of those under their supervision. So with an LLP, you do have personal risk, but only based upon the acts that you perform as being a partner of that business organization. Advantage of partnerships: more financial resources because you have more than one owner. You have shared management and skills and knowledge because, again, perhaps I'm great in accounting, you're great in marketing, someone else is good and great in technology. So we're sharing our resources, our skill set, longer survival because you do have more than one owner, and there are no special taxes when it comes to the partnership. Each partner pays taxes based upon their share of the profit or loss of that business organization. Disadvantages are limited liability. So, again, with a general partnership, then each party is responsible for the debts of that business, even if they were not involved in the decision making process. Of course, the profits have to be divided among the partners. Disagreements among partners. Perhaps we don't all have the same business philosophy, or someone has outgrown the partnership. How do we terminate? So what I do recommend strongly, write this down, that if you're considering forming a partnership, you put in writing what's known as a partnership agreement, and you will outline everything such as who made what investment, who's responsible for what obligations, how we divide the profits, how do we determine if one partner leaves, how do we dissolve the partnership. All that information needs to be in writing. Let's look at the ethical dilemma. Imagine that you and your partner own a construction company. You receive a bid from a subcontractor that you know is 20% too low. Such a loss to the subcontractor could put him out of business. Accepting the bid will certainly improve your chances of winning a contract for a big shopping center project. Your partner wants to take the bid and let the subcontractor suffer the consequences of his bad estimate. Question is, what do you think you should do? Should we allow this subcontractor to put a bid in that we know is too low and that will hurt their business, although it would benefit our business? What do you think you should do, and what would be the consequences of your decision? Feel free to email me your response regarding this matter. Okay. Next up, we have corporations. And there are different types of corporation. First up, we have what's called a C corporation or conventional corporation. This is a state chartered legal entity with authority to act and have liabilities separate from its owners, who are the stockholders. So, let me ask you a question. Do you own stock in any corporation? If you answer yes, then you are part owner of that business organization. So again, you become owner of a corporation by purchasing shares of stock into that business organization. Advantage of corporations, limited liability. So when you become a stockholder, you're limited in liabilities based upon your investment in that company. So if you spend $1,000 on stock, yes, you could lose that investment, but that is going to end your liability for that company. Corporations able to raise more money for investment because again, every time they sell a share of stock, that's money going into the actual business. Corporations are normally going to be very large companies. They have perpetual life, which means continuous life, because in the next slide, you have stockholders constantly buying and trading stock into that company. So change of ownership is very easy, is because every time someone else buys stock in that company, they now become part owner. Ease of attracting talented employees, separation of ownership from management. Again, remember, just because you bought stock in that company, you are not involved in how to run the actual business. Disadvantages. There's a pricey initial cost to set up a corporation, and that amount varies from state to state. There's extensive paperwork to form a corporation. There's something called double taxation, and let me explain that a little bit more in detail. Pretty much, the corporation pays taxes on their earnings. Then, as a stockholder, you receive what's called dividends from those corporate earnings, and then you pay taxes on those dividends. So the corporation doesn't pay taxes twice. However, the same income that was earned is taxed once at the corporate level, and then the stockholder pays taxes on that same money. It's difficult to terminate a corporation, and there could be conflict between you, the stockholders, and that company's board of directors. We're going to come back and continue our discussion on the different forms of business structures.